Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I wanted to talk about the Canadian dollar and the main question, as one prominent FX website asked it, of whether the Loonie can indeed break free. The Canadian dollar, as many of you recall, remains one of our preferred currencies from a long-term perspective, but it has faced headwinds in recent weeks from two sources. One has been a retreat in several commodity prices, including that of oil, which is a key Canadian export. The second has been from a strong US dollar, as the Fed pushed rate hike expectations higher a couple of weeks ago, following a high inflation reading ahead of his policy meeting. Now, these headwinds have not been unique to the Canadian dollar alone and have been a short-term drag on several commodity currencies. Having said that, while it's very possible that the Canadian dollar stays somewhat range-bound in the short term, we do expect the Loonie to eventually break free and strengthen over a longer time horizon. The rationale, of course, comes back to two main drivers. The first is oil and energy prices, where we expect a continued grind higher. Prices have cooled somewhat since early June amid US efforts to improve relations with Saudi and other efforts to boost output globally to help cap energy prices. However, as we discussed in yesterday's podcast, the risks of further oil price jumps remain high. While G7 leaders continue to work on possibly capping the price of Russian oil imports, there is a risk Russia retaliates by reducing supply, pushing prices back up again. A recovery in Chinese economic growth and hence oil demand could also be a more structural driver of higher oil prices. This is why we remain of the view that there is room for oil prices to stay elevated or even grind slowly higher. For the Canadian dollar, this is a positive factor, in our view at least. The second is domestic central bank policy. In a story similar to what we witnessed in the US not too long ago, Canadian CPI inflation rose in May sharply to about 7.7%, well above consensus expectations and the central bank's own forecasts. While jumps in energy and food prices were one key driver, a jump in shelter costs, which are more sensitive to central bank policy, was another key driver of inflation. While the central bank has hiked policy rates by 50 basis points previously, market expectations of a 75 basis point rate hike at the next policy meeting on July 13th look increasingly likely and priced by markets. For the currency, we continue to see this as a positive, as it increasingly places the Canadian dollar in a very small group of currencies where the central bank is hiking policy rates at a pace close to or possibly as fast as the US Fed. Now, this can be a key source of support in markets where the US dollar remains strong and relative interest rates remain a key driver of currency markets. Now, given this positive backdrop, what can shorter-term technicals tell us? Over a shorter horizon, the outlook is likely a range-bound one for the USD-CAD currency pair. On the upside, there's strong resistance in the 130 to 130.305 range, marking the two recent tops. This resistance is key. A scenario where the currency pair breaks sustainably above this could weaken our view, though we'd argue the risk of such a move is low unless we see a new wave of US dollar strength or a collapse in commodity prices. On the downside, technical support sits at 1.285 and around 1.280. Over the horizon of the next few weeks, we expect these levels could mark a short-term range the currency pair could hold in the face of a still strong US dollar. Having said that, a break below these key support levels is what could start a longer-term move towards our long-term objective of 1.25. So, a couple of key levels to watch, range-bound in the short term, but we remain bullish from a longer-term perspective. But we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.